Today, we are diving deep into one of the biggest secrets of our modern world, something you use every single day but probably don't know the whole story about: money.
So let me ask you, where does money actually come from? Now, if your first thought is, well, the government prints it, you're not wrong, but you're only seeing about 3% of the picture. The real story, well, it's way stranger, and it all starts with the system's own rule book. All right, let's start at the very beginning. Let's trace how the very first dollars in this system are born into our economy. Now, what's so wild is that we're not pulling this from some fringe website. Our main source is the Federal Reserve's own publication, a little booklet called Modern Money Mechanics. They lay the whole thing out for anyone who cares to look. It all starts right here in 3 simple steps. First, the government needs cash it doesn't have, so it issues an IOU, what we call a treasury bond. Step 2, the central bank, in the US, that's the Fed, buys that bond. But with what money? Well, with money it literally creates out of thin air, just by typing digits into a computer. And boom, step 3, the government takes this brand new digital money and deposits it into a commercial bank. Just like that, it's official. And here's where it starts to get weird. Only about 3% of all the money in the system is physical cash and coins. The other 97%, it's just numbers on a screen. For the most part, money isn't something you can even hold in your hand. But listen, that first deposit, that's just the seed money. The real explosion, the part that multiplies the money supply like crazy, that happens next. This whole process is called fractional reserve banking. The concept seems simple enough, right? Banks have to keep a fraction of your deposit, let's say 10%, in reserve. The rest, they can lend out. But how they lend it out, well, that's the secret ingredient.
So let's go back to our example. The government just created $10 billion and popped it into a commercial bank. That's our starting point.
So, following that 10% rule, the bank has to set aside $1 billion as its required reserve. But that leaves $9 billion as what they call excess reserves. And this is what gives the bank the license to start creating new loans. And here it is. This is the part that just blows my mind. And again, it's straight from the Fed's own booklet. They say banks don't actually lend out the money they have on deposit, because if they did, no new money would be created. Instead, when you get a loan, that money is created for you right then and there. Brand new. So someone borrows that newly created $9 billion and, of course, they deposit it in another bank. And guess what? The whole cycle starts over. That bank keeps 10%, so $900 million, and then creates $8.1 billion in new loans. This process just keeps going on and on, with each step creating brand new money. That original $10 billion deposit can end up expanding the money supply by nearly $90 billion. It's incredible. Okay, so we've got this massive, massive expansion of the money supply. But what does that actually mean for you, for me, for the money in our bank accounts? Well, that brings us to the hidden tax of inflation. Think of it this way. Imagine you have a glass of juice. Now, what happens if someone keeps pouring more and more water into it? Your juice gets weaker, right? It gets diluted. Money works the exact same way. When the supply of money grows and grows, but the amount of actual stuff to buy stays the same, every dollar you have buys a little bit less. The new money essentially steals the purchasing power from your old money. And that, my friends, is inflation. And the long-term damage is staggering. What you could buy for a single dollar back in 1913, the year the Federal Reserve was created, by 2007, you'd need more than $21 to buy the same thing. That's a 96% drop in the value of the currency. The system is designed to be inflationary. But it's not just about inflation. There's another side to this coin, and it's that this whole entire system is fundamentally built on a mountain of debt. Now get this, because all money is created when someone takes out a loan, it means that every single dollar in circulation represents a debt somebody owes to somebody else. Here's the kicker. If everyone, the government, corporations, you and me, if we all paid back every single cent we owed, the entire money supply would literally vanish. It would shrink to zero. And you can see it right here in the data. It's undeniable. You plot the growth of the U.S. money supply next to the growth of the national debt, and the curves are practically identical twins. More money equals more debt. More debt creates more money. They are locked together. You know, this isn't some new discovery. Here's President Andrew Jackson, all the way back in the 1830s, talking about the central bank of his era.
He saw this toxic link between a central bank and inescapable national debt. He ran his entire campaign on shutting it down, and he actually did it. And in 1835, for the only time in American history, he paid off the entire national debt.
Okay, now for the final piece of the puzzle. This is where the true, inescapable logic of the system really snaps into focus. Let's talk about the unpayable interest trap.
Just let that question sink in for a second. The banks create the money for the principal of a loan, right? You borrow 100 grand, they create 100 grand. But you have to pay back 100 grand plus interest. So where does the money to pay the interest come from? The stunning, terrifying answer is it isn't. It's never created. The total amount of money in the economy only covers the principal on all the loans. The money needed to pay the total interest on all that debt simply does not exist.
You know the best analogy for this? It's a giant game of musical chairs. There is always, always more debt owed than there is money in existence to pay for it. And what that means is that defaults and bankruptcies aren't a bug in the system. They're not a sign of failure. They are a mathematical certainty. Someone always has to be left without a chair when the music stops.
Which leaves us with one final, very critical question. For a system that structurally requires never-ending debt and constant inflation just to keep from collapsing, what is the endgame? If you want to keep pulling back the curtain on how the world works, make sure to follow, like, and share. You can also find our educational brand, What Bitcoin Taught Me, across all socials: Twitter/X, Nostr, Blue Sky, Threads, Instagram, Facebook, and LinkedIn. Thanks for tuning in.